MinRes deal. And we're live, apparently. Welcome to this episode of the Australian Investors Podcast. If you're tuning in live, hello. You'll be joining us. We're here in Melbourne, recording from the office today. And as always, joined partner in crime, Drew Meredith. How you going, mate?
How nice is it being in person?
Yeah.
Like we did a few remote there for a while.
Yeah. Were dark days.
Yeah.
Because there's no filter on this episode and it is live, I should mention that anything that you hear in this episode is strictly limited to general financial information only. We don't know your needs, goals, or objectives, so be sure to speak to a financial planner, like say Drew here, or anyone that you can verify on the moneysmart.gov.au website before acting on the information. If we refer to things like insurance, super funds, ETFs, managed funds, whatever, just remember that those things come with something called a PDS, a product disclosure statement, or a TMD, target market determination. You can read those, and I would highly encourage you to do so before you invest or what they call acquire a financial product. I don't know about you, but that word...
I wasn't laughing at that. I was having a chortle about something I was thinking about.
Just off in the clouds. I always
pay attention to the disclaimer.
Always.
Yeah.
Most important and probably the most interesting part of our conversations. But I always find it funny that we call them financial products.
Yeah.
I mean, it makes sense, but at the same time, if you were to walk up to Joe Bloggs on the street outside, you'd be like, "Hey, what do you think of these products?" They wouldn't
You
be
call
like,
me a product.
No, but they wouldn't be like, "Oh yeah, there's Australian Super and his Host Plus product."
Yeah.
Seems a bit odd.
Yeah, very depersonalized.
Yes.
Yeah.
Anyway, what have you been doing?
I was having an interesting conversation on the way in this morning. And maybe everyone's getting a similar feeling at the moment too, which is like, does the election process for US president last longer than the term of a presidency? This feels like it's going on forever.
Yeah.
And it's starting to impact markets. I mean, that's the relevant. That's my segue into markets. But it seems like every day there's a rally, every day there's headlines. And we're in Australia. I can't imagine what it's like, the headlines in America. I prefer to watch as little TV as possible unless it's streaming. But it seems like it's never ending.
Do you have a bias towards streaming?
I just don't barely turn the TV on anymore.
Oh, right. Okay, like free to air.
Yeah. You have to air quote free to air now.
Free to air. Yeah. Oh,
it's just what's there to watch anyway?
Yeah.
News, and this is bad news.
Yeah.
Like if I want to know that, I'll just go on the internet on the way home. If you're going to get bad news, may as well get it in short snippets, not a full half an hour of it.
That's so true.
This is what grinds my gears.
Oh yeah, you got another bee in your bonnet. A few years ago when we moved into our house, it was COVID. And I saw the antenna on the roof.
2021, 22. 2020, yeah.
I was looking on the roof and I was like, that antenna, that's the first thing. That and that dodgy old wattle down the back there coming down. And literally like within 24 hours, I went up there,
snapped it off,
cut the cable, pulled it off the roof. I'm like, that's done. We're never watching free to air. We have missed it because some of the footy in that is...
You actually cut off your antenna.
Yeah.
Right, yeah. I thought it was a metaphor.
It's a metaphor. No, yeah. So, yeah, we just snipped it straight off, mate.
Yeah.
She's gone.
I mean, you don't really need to anymore. And I'm 100% serious. Like on the way in, most news outlets have Instagram or social media pages where you get the most pressing news. And if you're in finance, we're reading the Fin Review all day, so all the kind of global geopolitical news comes out through there. Maybe I'm just keeping my head under. And now it's just politics.
Yeah, I listen to Bloomberg. That's the only one that I tune in for.
Tom Keane.
Well, I just watch whatever's on the TV in front of me, to be honest. So I have a smart TV that sits above the computer. Talk about screen time.
Double.
Many can do at once.
Double.
And I have Bloomberg, because you can get it on YouTube, Bloomberg Asia TV or Bloomberg Live. And I watch that. And that's really, I would say that's, what's the
subconsciously
right word?
Going into your brain?
Well, that too.
Yeah,
osmosis. But what's the word where you're not actually, it's not biased in terms of, it's not like Fox and it's not like whatever
independent,
the other
center, or just
center. It's
Central.
Not, it's just kind of
reporting
in the middle, and it's still business, but it's focuses on some politics and it tries to get, I would say, as accurate information as possible.
And if you've got a call on the outcome, it's all the articles I'm reading suggesting it's a landslide to DJT, Donald J. Trump.
Oh, right.
Yeah.
Trumpy.
I'm not sitting either way, but apparently I think this happens every year though. You get a trend and everyone predicts a certain direction, but it's actually much closer in the end. Have you got a vibe?
Well, just zeitgeist. No, I would say that it's been really interesting to see the politicians in the US take to social media as a proactive
Yeah.
form of communication this time around. Because remember, in the US, they don't have to vote,
And everyone loves a prop. Yeah.
so they've got to like activate people, and it's very different to in Australia where you get fined
For not voting. Yeah.
for not voting. So
And that's why we have more donkey votes.
yeah, you do. You get a lot of Mickey Mouse almost wins every election. So, but I would say on the balance of it, it seems like it would be a Trump, JD Vance
Yeah.
victory, just based on the polls. I don't know much about US politics. let's
Who
be
actually
honest.
knows? Yeah.
But yeah, I think that there's been a lot more exposure of the political parties through social media this time, like good, I guess, exposure. Whereas last time it was all the big tech companies,
Facebook. Yeah, I remember that.
like
Meta,
meddling
yeah.
in the elections. This time around, it's actually the politicians embracing social media, like going on podcasts, doing interviews that are off the major television networks. And it's interesting your point before. I can't remember. I think it would have been at least 5 years ago now that YouTube, as a platform for streaming content, is more watched than every single cable television network in the US combined. So if you think about how powerful that is, and the platform you mentioned, streaming, it is so much bigger, so much bigger, like bigger than anything before. And I think that just speaks to the whole world's move to streamed content. And if you have a smart TV anyway, you can download the 7+ app
And
or
watch it through streaming.
SBS. Yeah, and you still get some ads, but at the same time, you get what you want.
Exactly.
Yeah.
What was more interesting this week was Zip delivering another solid result.
Yeah, Zipco. Do you still hold it?
I do.
So your blended price, I think we worked out, is somewhere between $4 and $6, and it's back at $3.07. Wow.
It's up 11% this week, or in the five. Maybe that's not this week. Over the last 5 days, up 11%. Probably even more this week.
Annualize that.
Yeah.
It's interesting because we had a questionnaire right in last week
395% year to date
with the name Diamond Hands.
Oh,
So this could be you.
A reference to Jay-Z.
Well, it could be.
Yeah.
Hope it's not P Diddy, but it could be.
No, diamonds.
I think what they actually mean is Diamond Hands. That's
just a niche reference for the 2000 hip hop fans.
More of a K-pop type of guy. No, but the Diamond Hands is the idea that you don't let go of a stock; you just keep holding on to it.
Oh,
yeah.
And not Larry Diamond, the founder of Zip.
Wow,
There's
maybe
too many options.
I didn't think that this was deep in the subconscious. This person picked a really good question name. I should have rewarded that last.
I don't think I'll ever sell, to be honest.
Really?
Yeah.
It's one of those forever stocks.
Oh, it'll be pried out of my hands. I'm sure there'll be a takeover offer. Block or someone will come in and take Zip over as well as it took over Afterpay. I think someone will just buy it and it'll disappear.
Yeah.
At this point, there's no point.
Well, how many million?
But call it Diamond Hands. These make sense.
Diamond Hands, true.
Yeah.
How many? You've got it in the notes. How many?
4 million people in the US in the last quarter
using the Zip platform to make payments.
Yeah.
So this is a company, for folks that don't know, it's a buy now, pay later company. It's kind of like fractional payments is how I kind of think about it.
Lay-by.
You can buy things.
But not lay-by.
It's like lay-by in advance, I guess is the right way to think about it. So
invoice financing.
Yeah. And you can buy something, you get the product, you pay it off over time. But to have 4 million clients in the US, that's big. It's not a lot of companies.
It's only been a couple of years too.
It's not a lot of companies that can cross the pond and go over there from Australia and actually get traction. I know they've made a lot of acquisitions.
Maybe they were better suited. They did buy, I can't remember exactly what the business was over there. Maybe they took a slightly different tact to Afterpay. Like Afterpay is still so seamless to use. And Zip was always targeting a more, higher level of loan or kind of a different profile of borrower. So maybe that's why it did it. But in transaction volume up 23% on this time last year, 2.8 billion in the quarter.
Wow.
So it's, kicking goals. Still not resulting in share price. I mean, it's up 4 times this year, but needs to go up another 4 times.
Well, it kind of looks, it's interesting. It's obviously fallen off a cliff and now it looks like it's going up a very comfortable hill. It's slowly it's just, plodding its way back up. But you could live through this. You could, in 10 years from now, you could be holding one of Australia's biggest tech finance things.
4 billion market cap.
Yeah, she's coming back, mate.
And no yield.
Not
I mean,
financial.
PE is not much, 540 times PE. But we don't worry about PEs anyway.
It's basically free at that price.
Buy, sell, or hold.
Yep.
Woolworths.
I'd sell it.
Sell it.
Well,
Everyone did this week.
did they?
I mean,
I did
it
see that
dropped
in your
for,
daily
for,
report,
for a
actually.
massive large cap to drop 5%. Has to be something significant. And then buy, sell, or hold Coles.
Wow, it is. Woolworths down 10%. I mean, I read a bit of your daily and some news about Woolies.
Reach out if you want that too.
Yeah, it's
Did you ever think e-commerce online sales would be less profitable than in-store sales?
I think that was I thought that was the most obvious thing.
Yeah.
We've had a new editor start this week. Shout out to Adrian, lovely guy. He gave us a money hack basically when he walked through the door. Monique, nod to you. He said that you can install this Chrome browser extension and it tracks the price of Coles and Woolies products. So you can get like
a browser extension.
Yeah, so I think they have those. So you can if you get like mainland cheese, or say in your case, Meredith
dairy,
Meredith
goat's cheese. Yep.
You can
still
set an alert, and it will track the websites online to see how much that costs.
Yeah,
which is very transparent, and I don't think that's good for the supermarkets. Like if you think about their profit margins, consumers finally have a tool that can track the prices of literally everything,
rather than trusting all those yellow stickers everywhere.
Oh yeah, and Chemist Warehouse is going to be exposed.
You just can't tell what the normal price was when there's stickers everywhere. I just discombobulated and have to walk out.
But
old man shouts at Chemist Warehouse.
But I would say that online commerce would not be as profitable.
Yeah, apparently, because I'm guessing that one, for that reason, you can compare prices, but two, you're being a bit more specific. You're more specific in actually sticking to your shopping list when you get there. I don't know if you've gone through a shopping centre or a Woolworths with a child, but everything's on everything.
Yeah, problems if I'm honest.
In a trolley, anything they can reach. There's extra yogurts going in there. There's 400 bananas. There's like 770 Kinder Surprises. All these things just pop up when you get to the end. I reckon Woolies been profiting from that.
I'm a big fan, Drew, of these. They're trying to do less of the things you don't like, and like one of those things is just going to the supermarket. I just don't like to go there. I'd rather just not do that.
It's fun with a child.
Yeah, even as an adult male going there by myself, I can tell you it's not that much fun.
Not really.
So for me, I use Coles online. I don't know why. It's just we tried them both, and that just seemed to be the better experience
with delivery.
Yeah, because what you can do with Coles now is how you had to in the past you'd have to pick a slot to get delivery, like tomorrow morning, the next day, or whatever, whenever there was a slot, and they'd come on those trucks like a beep beep, and they'd stop out the front, and you'd get your stuff. Well, now you can get Uber to deliver it. Basically, it's like a private Uber version, and it can come within the next 90 minutes. So if you're I really needed this stuff tonight, you'll get it in an hour.
You can. You just got to pay for it.
Yeah, but with a Coles Plus membership, it's free delivery.
Oh, you got the Coles
if you spend
Plus,
over a certain amount. Okay. So I'm like, well, of course I'm going to do that.
See you.
Yes. So
you're the one that's contributed to a 24% increase in e-commerce sales, and 14.5% of sales for Woolies are now online.
Wow, that's a lot of money.
Yeah.
When you think about that, that's a lot of money.
It's significant.
Yeah, wow.
So earnings, they cut earnings expectations down 6% below last year, but at 1.5 billion for the year. Still doing all right. But it's clear that, e-commerce is penetrating even more, but not as profitable. None of the extra side bits that come up from it. But I'm guessing that over time, more influencing, more ads on Woolworths platforms, more private label options going in is the way that they'll kind of shift that product mix.
I always think about Woolies and Coles have such a big reach. Think about the millions of people that walk through a door that says Woolworths or Coles on it every day.
Market share.
It's crazy.
Yeah.
There's so much optionality that they could take that in a different direction. The problem for big businesses like that is if they go and launch some other service, it doesn't move the dial.
Yeah.
And then if you've got a management team or CEOs that are not going to be incentivized by that, why would they do that?
Anyway. Like Masters.
Yeah.
It's a perfect example.
Yeah. Why would they, it was go big or go home with Masters, and they went home.
Yeah.
They went back home, back to Bunnings. So yeah, that's something I think about. There is that scope there, but I don't know about you, but it's kind of like investing in a core portfolio, the stuff that you're going to need in the future.
Yeah.
Aussie shares, US shares, a little bit of bonds, that sort of stuff. You don't need to go out every month and reinvent the wheel. So like for my Coles shop, it's like, what are the staples that we buy every week? Put that on a subscription. I don't want to think about it. I just want it to rock up every Wednesday morning. Bang, done. And now we do the same with organic food as well.
Oh, nice.
Just bang, done. Farm Box, shout out to you. Only available in Melbourne, sorry. So we do have a question here, and this is going to maybe catch you off guard a little bit. It comes through from Woofy101. Woofy.
Are we rascals or raskies?
Rascals, I think it is.
Yeah. We're rascals. Everyone else are raskies. Yeah.
Yeah, well, they can be whatever they want, really. Everyone's part of the family. So they say, I have made a couple of good investments and a number of speculative investments that didn't work out. Zip. My question is regarding...
You got a few more speckies than I do.
Mate.
Let's not open that book.
Where's Dubber going?
It is Halloween.
Spooky. Dubber 1.6 cents. I thought it was 16 cents. It's 1.6. That's sad. And now it's, when the chart goes to like straight lines as opposed to smooth
because
lines.
it doesn't trade anymore. Yeah.
Oh, God. Anyway.
What do you got for me?
They say, my question is regarding my two good investments of Xero, Xero, and Pilbara.
Pilbara, all right. You must have got Pilbara early.
I have 5x'd both.
Ah, there you go.
And currently they are valued in the 6-figure range. Okay. What general advice would you have for the future of these two companies? Do you see Pilbara potentially getting bought out? I've read a rumor on that. Do you see Xero paying dividends in the future? Would you sell some, keep a portion, and reinvest? They're just unsure of what the future may hold for these two businesses. Thanks, Wolfie.
Pilbara's down 30% from its high too. So if you had 6 feet, you probably had a lot more before Pilbara. So for context, Pilbara, the lithium miner,
yes,
essentially was an explorer startup, and it's one of those few that made it intact all the way to major producer.
Mm-hmm.
But like everyone involved in lithium price fell 90%. And the company, I think companies that haven't been producing and selling lithium have been worse off than companies that were. And Xero, what does Xero do again?
Something to do with something or other. No, it does accounting software. So we use it. You use it.
Yeah.
Virtually everyone in Australia uses it now for businesses, and it's probably where you get paid your super. It's probably where you get your pay slip from. You probably log into it and check your leave and all that sort of stuff. It's big in the UK. It's growing in Canada. It's growing around the world. I think I was kind of umming and ahhing about this. Xero, I think Xero is a better quality company. I think it's in my mind, it's like a top 5 company in Australia.
I don't see you having the growth that both these companies have seen in the last 5 years in the next 5 years.
Yeah, it's going to be harder. I think if I was to take the 5-year view, I think Xero's got a better trajectory than
Pilbara. Pilbara is cyclical.
Yeah, and like if you think about Pilbara just selling a commodity, it's commoditized.
Yep.
It's not as in control of its destiny. And a good example of this, just thinking about this, is like how can you best illustrate the differences in these two companies and their prospects? If you go into the most recent FY24, what is this? It's a market release version on the ASX. You'll see that Xero's got 4.16 million subscribers versus last year 3.7. So it's up 11%. But then additions fell. So the additions fell from 470,000 to 419,000. So that's still growth.
Yeah,
I think that's important to understand. Yeah. The thing about software companies is they can grow more in a year today than they may have in the previous 10 years. It just doesn't look that big because it may be slowing down sequentially or something like this.
Yeah.
There is the figure that I always look at with Xero is not just the subscribers, because that's important, but the figure that I've always looked at is the figure called average revenue per user. In Silicon Valley, they might call this ARPU. ARPU. It's not, yeah. It sounds like the guy that used to run the Quickie Mart in Simpsons. Yeah, that I think about it. Is that on purpose? So anyway, $39, $39.30 is the ARPU in New Zealand dollars for per user. So they're making $39 per user. If you go onto your Xero account, you'll probably see it's like $50 a month or $60 a month or something. So this is through the wash. That's up from $34.60 a year earlier. So what this basically means is, Drew, they're still adding subscribers, not as many, but still a heck of a lot. But importantly, they're making more from the subscribers. This is them flexing their pricing power, and this is the true sign of a competitive advantage.
Yeah.
Now, the key thing is you can't just keep stretching your prices. So you can't just up your prices to infinity, because eventually people will stop. There is a point where they will stop.
You can if you're Netflix.
You can if you're Netflix.
Yeah.
But everything in this business just keeps growing.
Ticking it to a point. Yeah.
Exactly. So it's a sign that they still have pricing power.
And that's just in their core business. So the opportunity from Xero is to then leverage, like you were saying before, leverage that audience that they have into something else at some point.
Yeah.
That's the way the growth opportunity would be within Xero as opposed to Pilbara.
Yeah.
What can Pilbara do? They can probably buy more mines. They can produce better, be more efficient, cut their costs, but they're never going to have the growth capability that Xero does.
No.
And that's why I'm guessing the PE of Pilbara, I mean, it's still pretty high for a mining company, usually probably because the share price has fallen so quickly at 33 times, but it's probably trading more like a 17 or thereabouts.
I remember when you first showed me this, you're like, oh, we'll talk about Pilbara today. Pilbara. Sorry, I'm from Melbourne.
Although WA people don't. Here comes the hate mail.
I remember when you showed it to me.
Derby next.
Yeah. It was like a sequential shift in the profit. It was the most explosive growth in profit I've ever seen in Australia. Maybe go back to like the Fortescue days to see something like that. And that was just unbelievable to see that.
Usually they get bought before they get to that production stage.
Yeah, and these guys did get there. The interesting thing in Xero's case is like forever and a day, they said, it'll never be profitable. Yeah. Well, surprise, surprise.
Now they don't want profit.
It went from $113 million loss.
Most of the time they don't want profit.
To a profit of $174 million in 1 year. What a switcheroo. That is a big change. Free cash flow, $340 million. This is a business that is in its inflection point. It is riding that S-curve. It's actually going up the steepest part of it now. Eventually it will mature, to the Wolfie's question, and eventually it will probably pay dividends. Xero has no need to do that because it can keep investing for more and more growth. But the key thing is eventually the relationship between customer acquisition, the price to acquire a customer, and the long-term value of that subscriber will start to come towards each other.
Yeah, and that's when you're in trouble.
That's when, at that point, they've got to make a decision not to keep spending on marketing, and they'll probably cut marketing and just keep reinvesting in their core business and paying dividends. But they also have convertible notes. So they have, they have debt. People don't really appreciate this. What these tech companies would do is they would take on a debt facility. Maybe they use it, maybe they don't. So what they would do is they'd take on debt, put that as a liability, and then they would have the cash and put that as an asset. So it basically nets each other off.
Yeah.
But a lot of companies would go and spend it. Xero didn't really spend it all, but they do have that there. So in the future, they would want to pay that off, I'd imagine, and just be purely cash flow, like rich, like a Apple or a Google.
And my big thing here would always be you got two big holdings. Just think about position sizing,
bring it back to reality.
And move on from there's probably endowment risk. Do we talk about endowment bias?
Yeah.
That you've got these well-established holdings, you love them, they both made you so much money, but there's more likely to be better growth opportunities outside these. So it could be a matter of reducing your overweightings and looking for more diversification.
Yeah.
They put you in a good position, but don't assume that's going to keep happening.
Yeah. Yeah. Good point. And it won't, definitely won't be in a straight line with either of these companies. I think if you've got a lot of money in Pilbara, I wouldn't want to have a lot of money in Pilbara, like unless I was the CEO or something running it. But it's going to be a very volatile ride, just simply due to the nature of mining and booms and busts and that type of cycle. You'll still get the same with Xero, but it won't be in the business. It will be in the share price, which is quite different. So there's less volatility in the business itself. And just keep an eye on those metrics I said: customer acquisition, free cash flow, average revenue per user, and net additions to the subscriber base at Xero, and you'll be fine. I think that the key thing is, though, that like Drew says, you don't want to build a portfolio on two stocks.
No. Diversify.
Diversify. Endowment bias is probably a bigger thing when people hit retirement, I would imagine.
Definitely. And question for you, Premier or Myer?
Oh, Premier.
Even after selling their apparel, they probably basically sold their worst business to Myer, didn't they?
Don't they own part of Myer, or is that Breville? Who am I thinking of?
No, Solomon Lew owns part of Myer, but they just sold their apparel business. Noni B, Katie's, I think it was, to Myer.
I thought they owned part of it.
I think they own part of it too.
Because then Breville owns part of, anyway. Yeah. It's a whole thing. I would just go Premier.
Yeah.
Whatever Solomon is hanging on to, that's what I would want to be hanging on to.
That's a good. There'll be a nice segue to the spin-offs question.
Go
If
for it.
Solly's spinning it off, don't touch it.
Yeah, don't touch it. Yeah.
Sorry, sorry, Solly.
Stay with Solly.
Yeah.
But no, I would probably
I
go
love a
Premier.
ride in your chopper, but no, it's fine.
Does he have a chopper?
Yeah, they're all down in, where they are. I don't have to say that again.
Oh, Solly. So what would you go with?
Yeah, I'd go the same. You walk into Smiggle and it feels like you need 6 journals just to live your life the same way you're living before. So love a good pen, love a good journal, love old-fashioned writing, even if no one can read it.
Yep.
And Peter Alexander, we're
Yeah,
coming
very
into
good.
Christmas season, matching pajama sets. It's money
You
for
got
jam.
one of those?
Yep,
Yeah,
for sure.
All right.
Mine's
okay.
got Bluey on it.
Maya. So one dog's breakfast to another, or satire.
Oh, I had a different show than Dog's Breakfast, a different word. It's got to be Maya, doesn't it?
Just satire.
Satire? Are you pronouncing that right?
I don't know.
Satire?
Yeah, sure.
Satire?
I never owned it. But
Chittery?
it's a business. It's an e-commerce business that sells luxury
Luxury.
goods.
Yeah.
So headline here or byline says.
So you'll be one of their biggest customers.
Yeah, I've got so much stuff. Online luxury retailer Satire's share slumped 17.3% to $1.77 following a disappointing trading update. The company booked its adjusted earnings before interest, tax, and amortization at $2 million. Jesus.
It's not much.
It's not much.
Down 47% this year.
Yeah. RBC Capital Markets, they downgraded.
Up 3% since inception in 2013.
How much?
3.
It's a long way to... Okay. So if we keep going down, we keep digging in the barrel. We keep looking under what else is in here. Oh, look, we've got Star Entertainment.
Oh, God.
So Satire or Star Entertainment?
Satire.
Really?
Yeah.
Star is...
it's still like we talk like it's a shocker. Yeah, it dropped 17% and its profit fell to 2 million, but sales growth actually increased. It was like 22% sales growth. It slowed from 26%, but it's still 22%. And who knows what the comparison is, but it's actually growing. People are spending money on luxury. I prefer that than a casino that's barely open.
Yeah. Do you think it will go completely bust?
I hate making calls on these things. It seems like it's pretty well supported. And it might be, we saw something that was similar with Crown, wasn't it? Where it was more of a take private. Yep. Like it feels like given the issues that have happened in this country with casinos, and we would never invest in them.
Why not?
That holding these assets privately.
Holding
these assets privately can sometimes make more sense when you're trying to, and you talk about private markets all the time.
Yep.
When you're trying to do a turnaround, when you're trying to improve this business, you kind of want the eyes of the ASX and millions of shareholders to disappear while you can just clean up and fix things. You don't have to report every change that happens. It wouldn't surprise me if it becomes a take private and a recovery story, and then it lists on as an IPO again. Private equity sells it, and we buy it back again.
Yep.
But I won't invest into it.
No, good points all around.
I just think there's so many other things to invest into other than gambling. We might gamble, by buying Zip or
take a punt.
Sport here and there, but casinos, there's so many other options to invest into that
you don't need to.
Easily exclusion.
Yeah, I feel like you could have someone could come out with an index ETF. It's like ASX 200 minus sin
stuff you don't like.
Yeah. Like it's not like you don't even need to call it an ethical thing. It's just literally these things. Percy Online said, morning coach and everyone. Good morning. Cooper said, the problem with Woolworths online shopping is the double handling they do in store. One person to stock the shelves, then another person just to put it on to the click and collect / delivery trolley. Yeah, I hear you, Cooper.
I almost got run over in store last night.
Did you?
It was like peak time straight after school and all packing trolleys everywhere.
Just like the staff picking.
Yeah, moving all the stuff around. It was,
But that's, in the, I think it was the late 90s or like 90s or 2000s, the old cinemas were retrofitted into other things. So like bowling alleys and a bunch of different, like they started as obviously like cinemas and theaters. And then as times evolved, they changed them into a different complex. And it's always interesting. I think people undervalue the location of certain assets. So like in Woolworths case, it has a store in your local metropolitan area, which could then be repurposed or used for a different thing. And you don't really think about businesses evolving like that, but they could be. Like, I agree with the click and collect thing. They get all the best car parks. But it could be something where instead of it being an experience where most people shop in store, it's actually just mostly staff in there.
Yeah.
And it's just a massive fulfillment warehouse that just happens to be in a
Getting
retail
there.
location.
Felt like that.
Yeah, Claire says, zip, shrug. Mr. Leftovers on YouTube says, hi guys, to what extent do you use AI to assist you while doing valuations? And what are some resources / sites that you use to help you leverage AI in your value investing strategy? Well, Mr. Leftovers, it's a great question, my friend. I
Is
do not
coding
use
AI?
What?
Coding, like just
Oh,
running
you mean like
code across
writing code?
data? Yeah.
It could be. I mean, not.
And you've automated a process, so maybe
You could
that's
ask
out of AI.
ChatGPT to do something.
Yeah.
Max in our team forgot the compound interest formula this morning with a little bit of a twist. So just use ChatGPT to write it for him. But I think the key thing is I don't use AI. I think it's a bit of a buzzword, Mr. Leftovers. And I don't know, I feel like we had Scott Bennett from Invesco who talked about, he was actually sitting
Quant
in that,
trading.
quant systematic factor trading, whatever you want to call it. He talked about it sitting in your chair right there. So big shoes to fill, Drew.
And Tash Invest before
and Tash
that.
Invest. Yeah. And Phil Lowe was sitting there the other day too. Gosh.
Which Phil Lowe?
Philip Lowe, the former RBA governor.
Really?
Yeah, bro.
I wasn't aware. That was my in.
It was in the chat.
Oh, that was my in. That's how I was trying to get a reference for the new job. You didn't tell me.
Yeah. No, he didn't. He just told me. He just whispered in my ear and said,
"Did you talk about the price of milk?"
Yeah, he said, "Listen, he's probably not right for the job. He's made a few bad calls."
Wouldn't be the first time I've heard.
I've heard of that, Darren.
At least I didn't tell everyone rates were going to be zero forever.
Savagery. Anyway, I will compose myself.
This is live too, isn't it?
Yes.
I could not edit that out.
You've had some thuggery on the show lately. Joe Aston's also coming for you too. So anyway, AI, don't use it, because the reason, Mr. Leftovers, is to the Scott Bennett point, is that these guys have been doing it for like 25, 30 years, right? And I don't see a human's competitive advantage to go against a machine at something that they're good at, which is numbers.
That was the question. I forgot what the question was.
So what I would say is focus as little as possible on the number crunching and let the AI do that. So let's say, for example, you use the ticker terminal, TIKR, there's no E, TIKR. If you use the ticker terminal, you can just get data and you can chuck it in the spreadsheet, do whatever you want. It's about $20 a month for the good one. And what you can do then is you can just say, hey, create a chart of this. If you're not an Excel person or a Google Sheets person, you're creating a chart, calculate the free cash flow or something like that. Just chuck it into, ChatGPT. But I think this is like, even in our value investor program, Drew, where we talk about like what is value investing? Value investing itself has evolved. In the 1920s, Ben Graham was writing his book, Security Analysis. He was talking about cigar butts, like price to book ratios, that type of stuff. That's no longer.
It was relevant when 80% of the companies had hard assets, infrastructure, railroads, manufacturers. They all had
and no one
assets.
could get the info.
Yeah,
like no one.
It's not relevant now.
Yeah, no one could. You had to, up until like 40 years ago, you had to request an annual report be mailed to you.
Yeah,
and it come through. It was like this thick and whatever. You had to then go through and manually, with a ruler and a pencil, calculate the price to book ratio, calculate this, then call your stockbroker or go down and buy the shares. So if you had ChatGPT then, you would have been a wizard.
Yeah.
But if you've got ChatGPT now,
useless.
Everyone's got it. Useless. I would actually say potentially dangerous for people that rely on it. I found a lot of risk.
And more like ChatGPT is more useful to use the research that you have and summarize it, if anything, to kind of simplify and speed up everything you do.
Yeah.
Like artificial intelligence coding, most of these things run off programs anyway.
Yeah.
And they'll do analysis. You'll change an input. That's not really AI. I don't see that as AI. I see it's just coding and automation.
Yeah. Agreed.
But the use of AI to simplify things, and if I get the amount of 30-page research reports that come out, put into ChatGPT, what's the 5 most important take? All right, should I buy it? No one asked that, but I'll make the decision after I've spoken to ChatGPT.
There's like, I feel like what would be, if you're an individual investor, right? Let's just say, obviously you're a financial advisor, but say like someone that's just out here watching this or just listening, what would be their advantage as an individual investor? Like, what do you think?
Just generally,
yeah,
the time.
holding period.
Yeah, they literally
But they did a hold zip for forever.
Yeah, I mean, you extend your time frame, the more potential for returns you have. But by far, we were talking about it on the Australian Retirement Podcast recently as well. Even when you get to retirement, you've still got 20 to 30 years that you're going to invest. But the problem is if you're a fund manager or a professional stock picker, your bonus is based on what you're doing every day, every month, every quarter. You're constantly benchmarked back to the index, which means you can be forced to make, be more exposed to the index, be less exposed to the index, and you have all these biases that come in. You literally can be a buy and hold for as long as you want.
Yeah, I think that's the true advantage. And RBT Cat's dialed in. G'day, RBT. Guys, do you know that there is no reasoning ability in the large language models that are used by AI? Yeah, and that's the thing, exactly, right? If you're looking for an insight into a company or some type of industry, you're going to hopefully be one of the first people that discover that insight, or you have this human approach to it. That's not going to be in a model that was built on data that everyone has.
Yeah.
So you're looking for the things that the data doesn't have. And I think that's kind of the key inside RBT. So well done. There's a couple of quick ones here from online as well, Drew. Premier, says Claire. He just flogged his dogs to Maya and remains with the nuggets he's listing. So good.
Nuggets.
Brenton says, Owen been getting some clearance deals at Rivers. Very...
Continue.
Anyway, so good. CPI data. That's that stuff they say is inflation.
Inflation, yeah.
2.8%.
My goal's not looking very good. It's going to be expensive handing out all those books next year.
So remember, Drew said if interest rates fall, was it 50?
Easter?
Was it 50 basis points?
Was it Easter or June?
I think it was the end of March.
I thought it was Easter.
Okay, by Easter 2025.
Oh, is it late Easter this year?
It's 50. Was it 50 basis points for 0.5%? I think. If interest rates have not fallen by 0.5% by the end of March,
you get a book. You get a book. You get a book.
Drew's going to go all Oprah Winfrey with the golden years on us, and he's going to give everyone that listens to the show a copy of his book.
Premier owns 30% of Maya, by the way.
Premier owns 30% of Maya, by the way. Just
and now 30% of the old brands that it just sold.
So Louis just going, hey, take that for me, would you? I own a bit of you, but that's phase two.
Yeah, phase two.
Phase two is see you later, Maya. Yeah, hold this for me.
Data. Here we go. 2.8%.
2.8%. We're in target range.
We are just, but apparently, and this wasn't in a lot of the data. We just passed out a energy supplement across the country, which everyone's saying cut at least, I think 30.3% or something off it. So we're actually could be more around 3 at the moment, but it's similar trend everywhere else in the world. It's falling, and it's not falling quickly because it gets very difficult for price, and not everyone wants to have a little bit of price. Slight price inflation is good because we all want to be paid a little bit more. We all want a little bit more, but getting it down from the 3 to the 2 to 3, that very arbitrary range that for some reason we target. I'm sure there's some statistical analysis on that. It was good, generally good news. And quarterly was 0.8% inflation. Again, quite a positive. But traders are pricing in a 50% chance of rate cut in February, and 1 in 3 chance of a move cup day. I could be in.
If you get it right, then everyone else here has to buy you a book.
That'd be cup day, cup week. Yep. Any book they like.
Any book.
Yep. I've got 4 I'm trying to read at the moment.
Really? What's on your list?
Die with Xero. You weren't supposed to see that. Stoics Bible.
Jeez.
No
wonder you're not getting strong.
There was one other one. The Golden. No, sorry.
The Golden. You still read my own book.
It's your unwritten book.
Yeah. So Tim says you guys did an episode on PL8. Is that Playo?
Playo. Yeah.
A while back. You want to talk about it again? Hearing people chit chat about things is how I learn. Hey Tim, that's great. I think I could be wrong. Not to name drop a little bit, but I think we might.
Dr. Don Hampson.
I don't know. I sometimes I just roll into the office and someone's like,
yes, you're in today.
I'm like,
are you prepared 3 weeks in advance for that? Let's not forget.
No. Like
this is your profession.
Then I just rock in. It's kind of like Monique behind the camera here. She's like, we're doing what today?
Don't pull Monique down with you too.
But yeah, I think we may have Playo on the show soon.
Dr. Don.
Or it could be on the retirement podcast.
Yep.
Drew might be doing.
Good to know. Thank you.
Yeah.
Also prepare exceptionally well. I
Yeah.
mean, it's probably relevant. It's up 21% year to date. Fell below its benchmark and provided an income of 8. I mean, that's a good story in incredibly niche, specific strategy. So literally, Playo invests in companies that have got high franking credit balances and are paying out a high portion of franking, and they turn over that portion of their portfolio a lot.
It's good for retirees.
They hold a fair bit pretty core. Like from memory, CSL was in their portfolio, but as in the part they don't trade, and they trade another part significantly faster.
Because it's because one of the secret sources, if I'm not mistaken, tell me if I'm wrong, because I probably am. A big part of their strategy is basically the franking credits play, which is along the lines of, if you're a big global investor buying Australian shares, you don't get franking credits because you're not Australian.
It's arbitrage.
So if you're in, and that's why they get sold off, and why some investors buy shares after the franking credits or before the franking credits just for that period.
Yep.
So they can get franking credits for 45 days. And so it's kind of like a franking credits harvesting strategy. And at the end of the year, you might end up with like 1% better than the index or 0.5% better than the index. Now, obviously, this is for big investors with the ability to buy lots and lots of shares. But that's, I think, part of it as well, is that they can scoop up the franking credits, whereas a lot of the other businesses overseas won't value those shares as highly.
Yeah, exactly.
Yeah.
And it happens every time.
Yeah. Okay.
And no one can quite understand why.
Alphabet results.
Alphabet's solid result. This is like the biggest week, some $12 trillion worth of market cap reporting. I don't know why we say 12 trillion, it just makes it sound interesting. Like it does, who cares how big the company is it's reporting. Alphabet, we also, maybe we'll get into those next week. We had Meta announce overnight, and we had Microsoft. Microsoft had a standout last night too. Share price barely moved, which is probably a good thing. Revenue up solidly, and I think all of this was a bit unexpected because the strength of the share price in the Magnificent Seven, everyone started to get a bit worried about growth and earnings not being able to keep up. But solid result. You had YouTube continuing to kind of surge away, and as the main search business continues to grow more like Woolworths and Coles, like 3-4%, where the rest of it's growing 20%. AI is the question there too. I mean, Waymo, I think Renato and the team from our office were traveling in San Francisco and had the first automated driverless taxi, not automated, driverless. But that's Waymo. It's one of the moon shots. Is that what they call it? Moon shots from Google.
Yep.
They've also been doing a lot in AI. So it's actually, I was looking at the Meta results on the way here in the morning, and it was actually Meta's using AI for things like chatbots. So when people are engaging with companies via Facebook, having a much more intelligent chatbot that's talking to you, I thought that was super interesting.
Yeah, they're doing a lot.
Applications that you don't really expect.
They're doing a lot because Meta's basically just gushes free cash flow. It's like, where do we put it? Well, we can create AI models that other businesses can use, which is what they're trying to do. Whereas OpenAI seems more keen on pulling other businesses into its system. Yeah. Whereas Facebook seems to be doing more for other developers and other groups to leverage its systems, which is really
that's where a massive opportunity is going to come from.
What's the market cap of Meta/Facebook?
Do you reckon that Meta will change its name to AI Book?
AI Book.
There was an article that everyone went to the metaverse and it was empty. Meta platforms, apparently it's up 400% in the last 2 years. So I'm guessing the market cap would be $2.5 trillion US.
I'm glad I sold this.
Said no one ever.
It's gone up 5.8x since I sold it 2 years ago. It's up nearly 6 times. Up nearly 6 times since I sold it. Wow.
2.5 trillion.
1.5 trillion.
2.5 Aussie.
Which is
2.5 Aussie.
Ren from Equity Mates, I'm still keeping track. On Ausbiz one day, he was hosting and he said, bet you 6-pack, it never gets to $1 trillion. Well. Look at this.
So he won.
No, I won. He said it wouldn't.
Oh, it wouldn't?
He was like, it's an old platform. No one uses it. Well, look at me now.
That's before it became Meta.
I don't drink, so I'd have taken it up on something else. What else have we got here, Drew? We've got a couple more questions we could probably get through.
Fishing lures.
Fishing. What is it?
We'll take payment in fishing
squid
lures.
jigs. Send them over. Okay, here we go. This one might be interesting from Roger Federer. Yeah. because we did promise we'd get to this one last week.
No, this is not a person called Roger Federer. This is named after the famous tennis player.
No, I'm pretty sure this is the Roger Federer. Yeah, because he says 45-year-old single bloke,
Yeah.
which I think he's older than that. And I don't
he
think he's single.
has twins.
And he said he inherited a 20K. We could be. So we'll assume that it's Roger Federer.
Let's switch to 20K for B. We'll pretend it's
20.
Roger Federer.
20 billion.
Each.
So he inherited 20K of AFIC, AFI, BKI Investments. So those are 2 listed investment companies. Suncorp, Telstra, and Woolworths from Dad.
Thanks, Dad.
Thanks, Dad. Keep both AFIC and BKI or sell due to redundancy. Okay, because it's so diversified. Sell down the single stocks, thinking of reducing leaks and going ETFs like IBV, NDQ, and an all-world ETF. Any general thoughts would be much appreciated. So generally, the question is, Drew, that they've inherited, this is very common. I mentioned it's very common with your clients too, is they've, from dad or mum or whoever, they've got 2 licks that tend to do really well, both AFIC and BKI. They got an insurer that's meh, a telco that's big but not very good. Meh.
You've already said you hate Woolworths, so let's...
And I got a Woolworths. Oh, I don't know. Very strong language. What would you do?
Well, my first, if this is the only 5 investments you hold, then I'd definitely just be looking to diversify rather than overthink it. And there might be some personal connection here. Something like AFI is going to be providing a very similar exposure to as the ASX 200. So why sell and buy it if you don't need to? That's something you'd be comfortable retaining with a view that that's your exposure to the Australian share market. If this is the only investments you have, it literally tracks the ASX. And then I'd probably just, given how narrow it is, and you're going to have 80% in 4 stocks, I'd be looking to diversify those and adding your age, more global diversification, more growth focus. So as you said, looking at some of those global diversified IVV, NDQ, infrastructure, property, there's so many options now, particularly in ETFs, and diversifying that way.
Yeah. It's I mean, we don't know who this person is. They say the name's Roger Federer, but we wouldn't know if it's the Roger Federer or a Roger Federer. But just generally speaking, 45 years old, I wouldn't be in a rush to do anything. And I would just say it's good to, this is probably an inheritance is a great opportunity to either see a financial advisor or start taking your finances a bit more seriously. Because if this is the first time that you've experienced investing, because we don't know anything else, if it was the first time, it's a great opportunity to have a kickstart.
Get engaged.
Yeah, start. You've already got some money in these stocks.
You don't have
it's probably 100
it.
grand there. You can just start to pay attention.
Yeah.
They're not like, these are definitely not like the worst companies. If someone appeared at the Waddle Partners office, I'd imagine you'd be like, okay, no worries.
A couple of them are right. Yep.
Yeah. They're not like specky stuff like Zip or whatever. Or double.
No one's got $20 worth of Zip that they can inherit.
Yeah.
20K, I mean. Sorry.
And then there's like IVV, NDQ. I would then think to myself, I'm 45. What's my long-term goals, medium-term goals, short-term goals? If it's a long-term goal to retire at 65, that's the most realistic thing. That's when super is going to become really important. So start adding to super, maybe build a little bit of wealth outside of super. And that all depends, right, on someone's situation. If they've got a lot of super already, maybe they don't need to do that. So it really just does depend here, to use your lingo.
It depends.
It depends. But
I've got a special.
I think you can add ETFs. Yeah, on the side. Drew's got some headphones down here, which he got engraved with. Yeah. It depends.
It depends.
It's a signature. All right. And
wait till I get the hats.
Oh, gosh. That's a great question, though, from Roger Federer, because a lot of people do, in this situation, kind of just have some money. I wouldn't be in a rush. That's the general gist. But there would be overlap, as Drew says. So just treat that wisely. Those 2 listed investment companies are really good investment companies. Of like all of the listed investment companies in Australia, I think they're 2 of the better ones. I think AFIC may have the dividend substitution plan as well.
Yeah.
Okay, what's the final question we should talk about?
Someone's asking for a book here, so I think we should read out that one and just whether I can't find, for some reason I can't find it at the moment.
Okay.
I thought that was there before.
So Claire says,
That's
okay, yeah, we'll come back to that.
Yeah.
Re-interest rates. If everyone in America spends galore on Zip, what happens when defaults become prominent? Oh, Zip, something happens to Zip, I guess. Not great, Claire. It would not be a good outcome for Zip.
But it hasn't yet. We've been through a pretty tough period.
Yeah,
too,
been
so,
through COVID, and we saw those arrears come way up, and they kind of handled it really well. I think one of the differences with Zip, correct me if I'm wrong, versus Afterpay's Afterpay kind of just flew forward without doing any sort of checks or balances, but Zip did take a more stern approach to that initially. Overall, I would say it's probably not a huge risk anymore, given it's kind of been tested, but who knows, Claire, to be honest. That's a good question for the business, to be honest. How will they do that? The question was from Nana got my book value. Please discuss spin-offs generally. Do either you or Drew like them as investment opportunities? And more specifically, can you discuss the recent breakup of Webjet and the other thing? Do you agree that such events cause forced selling, therefore disparity in company value? Also, this is my third bite at the Golden Years Cherry. Please send me a book. As my first two questions weren't picked up, I actually bought the book, but then gifted it to my mother-in-law as I felt it would be better for her in that moment. Thanks. That's a great gift to give someone. Yeah, well done.
I'm not going to answer the question, but you can have a book.
Yeah, just write into us on any of the Rask websites. You see that little chat bot in the bottom right-hand corner there? You can just send us in your name and just say, hey, I got my question on the show. Finally, Owen. And we'll send you a copy of the book. Give us your address so we can forward it to Drew. So spin-offs generally.
I don't think you have a general rule, but in my spin-offs or when a company's selling to another company, there's usually a reason they don't want it. A lot of the time is to say that they're releasing value for shareholders or giving people more options. But generally, it's not core to the business that they're running. I kind of like the business that's getting rid of it more than the business that's spinning it out. Endeavour was an example. I think Endeavour did. So Woolworths spun out Endeavour and did incredibly well for a period of time, but it's struggled since as a standalone entity. So I kind of prefer the the owner that's getting rid of it versus the spin out. And I don't think it's forced selling or that there's necessarily a clear disparity in company value. Capital markets are pretty tight in Australia. You don't really see this big arbitrage that happens in most cases.
Okay. BHP spun out South32?
Yep.
That was a good business.
It was a good
Still good business.
It's kind of showing signs of it now as well. I think it struggled initially because a lot of the debt went into South32.
Yep.
And it was a lot of the, basically non-iron ore assets.
Yeah. Minerals, that sort of stuff.
Which are more interesting now, but at the time they weren't core to BHP's business.
They also spun out the petroleum assets, but Woodside picked them up.
And Westphalia Farmers sold out Coles at one point.
Yeah, but just quickly, what a spin-off is when a big business sells a smaller business. They can be equally big, like they can split in half, but that's kind of rare. Typically, it's a big business that sells a smaller business, and usually it's for a few different reasons, but one of the big reasons is shareholders. Shareholders get the shits that a company is so diversified that, hey, I just like BHP's iron ore, sell that other stuff that's not making any money, get rid of it. I just want this. And so then if the company releases itself from that, they can have an iron ore company and they can have a minerals company in their brokerage account. So people often get confused, and there may have been a bit of confusion in this question from Nana, but you still own the same thing. It's just split up differently is what's important to understand. A good example of this is if you own Google, Alphabet as it's called, because for PR reasons and for regulation reasons, they renamed it so people wouldn't think of it as a single company. They have Google, and they have Waymo, then they have Google Cloud Platform, they have Workspace, they have YouTube, they have all these businesses inside it. And there's always been this call that they should be broken up. They were too powerful. Same with Apple, with the App Store and the subscriptions and the hardware. You need to break it up. And I've always thought, well, to be honest, if they broke up Apple, I'd probably just take the subscriptions business and leave the iPhone business off to one side. Yeah. Because the subscription business would be amazing.
You also sold Meta 2 years ago.
I sold it, so don't trust me. But like Meta would be a good example. So if you wanted to split up Facebook from something else, like from the metaverse goggles or whatever, you could do that. A lot of the literature suggests that the smaller company, is the more valuable of the two.
Because it can't grow in the framework of a corporate.
You know what it's like when you work in a big corporate. If you try and do something and then someone higher up says, that doesn't sound like a good idea, and just squashes it. Yeah. It stifles a lot of innovation. So they split them up. But sometimes businesses are better together.
Definitely.
Like say, there's been a lot of talk over the years between Brickworks and Soul Pattinson being cross-shareholding, but they've probably been stronger together overall, you could say.
More supported.
Yeah, so I don't know. Am I a fan of it? I'm probably a fan of it if you take a eBay and PayPal situation, because eBay owned PayPal. They bought it after Elon Musk and Max, whatever his name is, early in the day. So eBay sold PayPal, and then PayPal did way better than eBay.
Yeah.
And I just checked then.
But then eBay cut PayPal from their payments offering, didn't they?
Yeah, then eBay said,
eBay
no,
did way better
because they
than
had this
PayPal.
rule where it was like PayPal was the default payment gateway. So that's why it was originally bought in the first place, because eBay thought, well, PayPal's this payments business, and we're the most dominant business in online selling. We'll just combine them. But eBay is currently worth $30.6 billion, and PayPal is worth $80 billion. So way bigger.
Yeah.
So that a little company became the big company is the outcome of that. Now, Drew, I've probably run to time. So I just want to say thank you to everyone that joined us live, because this is the first in-person
I didn't even know we're
and
live.
live. Yeah.
I wish I did.
Well, Phil knows now. We've got a good question here. Do you think we won't see similar growth for Aussie companies as compared to US, as we tend to shoot down anyone who makes more profit? Yeah, it's true. We do.
Someone's been listening.
Yeah. Oh, yeah. That was last week's rant.
I mean, we're also a limited size economy, and you probably will see that growth from some companies, but just not the big ones.
Well, this is why I said Zip sounds interesting all of a sudden, is because I didn't realize its US business was growing so fast, because that gives it scope outside of Australia. And the way I think about US expansion, Drew, is they might have a 1 in 10 chance of doing well in the US.
Yeah.
But if that 1 in 10 chance, if it succeeds, is a 20 to 1, you should take it. Because 9 out of 10, you're going to lose. But there's the one chance that you get a 20 to 1.
Yeah.
And it's worth it. That's what Charlie Munger would always illustrate. So if that pays off for a company like Zip, great. And if Xero keeps growing in Canada, the UK, South Africa, all those different places, it will probably win.
Eventually, yeah.
Yeah, and it will probably keep growing.
Playing the long game.
Yeah, but it's a long road, and there aren't many companies like that in Australia. Obviously, the US is backed by the defense of the world's most powerful country, those US companies. So, they can export Americanism much easier than we can send, I don't know what we'd send overseas, but what have we got? Kangaroos.
TV shows?
Yeah. TV shows, yeah, we're pretty good. We're very good in the creative industries.
Yeah.
Anyway, that's us for today, Drew. You need to give us your dad joke before we settle off.
I do. I had one, but I thought it was going to be really hard to deliver. So I'm not sure if anyone's been watching Territory on Netflix.
Mm-hmm.
Great TV show. Got through it pretty quickly, probably quicker than I would have liked as well. And I've got to find something else. There was a link to cows, but it wasn't a joke I think I could adequately deliver.
Okay.
Yeah. And now I've lost the joke. Oh, here we go. I'm going to try this one, and then I'll try the other one afterwards.
Go for it.
I took up origami for a while, but I gave it up because it was too much paperwork.
Well, that was pretty good.
I'll leave it on that one, or I'll leave it on that one.
That was pretty good.
Yeah.
That's pretty good. I will take that.
Double joke.
And the fact that we're live, people could heckle you live. But I think that's pretty good, mate. Well done. If you want to get in touch with Drew or anyone at Water Partners, you know where to go. waterpartners.com.au. There's also a link in your YouTube description or in your podcast player. It says financial planner. You can get matched with a financial planner there. We get some great questions every week. The way to do that is to send them in via your podcast player. So this is the end of the episode. After it's done, just click that link that says ask a question. We are getting so many great questions at the moment. It is wild. And from that same link, you can select the Australian Retirement Podcast, the Finance Podcast, the Property, Business, Live Show, whatever you listen to on Rask, you can actually get it answered there, maybe in an email, maybe whatever. You just tell us where you want it, and we'll do that. And anyone that gets a question on the show gets a copy of Drew's book, The Golden Years, How to Live Irresponsibly in Your Latter Life. And then the other thing that I should say is the questioner of the week. I think all of the questioners had really good names this week for the Value Investor Program. So what the heck? You'll get the Value Investor Program for free. Just write into us on the Rask network and that little chat bot there, and you'll get a coupon code to use on the Value Investor Program, which is normally $499. Keep your questions coming. We love it. Thanks to everyone that joined live, Percy, Claire, RBT, everyone that's just in the chat now. Really appreciate it. And Drew, as always, thanks for joining me.